Hello friends, welcome to LU Update. I hope you all are doing well. Now, this video is regarding the discussion of 80 most important MCQs for the subject Principles and Practices of Insurance for BCOM 6th semester. Now, for the students of Hindi medium, I would like to inform you all that you all can go and download a mobile app from Google Play Store. The mobile app of LU Update is available there, and through this mobile app, you will be able to get access to Hindi medium classes where these 80 MCQs have been discussed, along with that for other students as well. This is the last video on YouTube regarding these discussion series. The next videos will be available only on our mobile app, so you all have to also go and download a mobile app, and that's where you will be given access to the upcoming videos. So let's start with the video. Now these are the 80 most important MCQs, so please do focus on these questions and please take into consideration this video for your semester examination. Now starting with the very first question, the question is the principle of subrogation does not apply to. Your options are life insurance, fire insurance, deposit insurance and burglary insurance. Now, the principle of subrogation generally applies to various types of insurance policies, allowing the insurance company, after setting a claim, to step into the shoes of the insured and pursue any rights or remedies the insured may have against third parties. However, there are certain exceptions to the principle of subrogation in the given options. The exception to the principle of subrogation applies to option A, that is life insurance. Now, life insurance is a type of insurance that provides a death benefit to the beneficiaries of the policyholder upon their death. Since life insurance involves the loss of human life, the principle of subrogation does not apply in this case. This means that the life insurance company cannot seek reimbursement from third parties for the death benefit it paid out. On the other hand, principle of subrogation generally applies to fire insurance, deposit insurance and burglary insurance. In these cases, if the insurance company pays a claim due to fire damage, a deposit loss or a burglary, it can pursue the responsible party or parties to recover the amount paid to the insured. Now, next question, in which year was the Insurance Act passed? Your options are 1936, 1938, 1942 and 1945. So the Insurance Act was passed in the year 1938, that is your option B. Moving on to next question. In which year did the Great Fire, the biggest fire known in the history of fire insurance, takes place? Your options are 1660, 1663, 1666 and 1669. So the Great Fire, the biggest fire known in the history of fire insurance, took place in the year 1666, that is option C. Moving on to next question. Where more than one fire insurance policy is taken to cover the same risk, it is called. Your options are block insurance, reinsurance, double insurance and average policy. Now, where more than one fire insurance policy is taken to cover the same risk, it is called option C, that is double insurance. Now, double insurance occurs when an individual or entity obtains multiple insurance policies from different insurer to cover the same property or same risk. In the event of a claim, the insured can potentially receive compensation from multiple insurers based on the terms and conditions of each policy. So the correct answer is option C, that is double insurance. Now, the term causa proxima implies that the loss must arise from. Your options are the nearest place, the ascertainable source, the cost insured against, and the unforeseen sources. So the term causa proxima implies that the loss must arise from the cost insured against, that is option C. Now causa proxima is a principle in insurance that refers to the proximate cause or the immediate or direct cause of the loss or damage. According to this principle, when determining whether a claim is covered under an insurance policy, the focus is on the nearest or most immediate cause that led to the loss, rather than remote or indirect causes. The loss must arise from the specific cause insured against for it to be considered covered by the policy. Hence, the correct answer is option C. That is the cost insured against. Now moving on to next question. Principle of indemnity does not apply to. Your options are life insurance, fire insurance, marine insurance and theft insurance. So, the principle of indemnity generally applies to most types of insurance policies, including fire insurance, marine insurance and theft insurance. However, it does not apply to life insurance. Therefore, the correct answer is option A. That is, principle of indemnity does not apply to life insurance. Now, principle of indemnity states that the insured should be compensated for the actual financial loss suffered up to the limit of the policy coverage without making a profit from the insurance claim. It aims to restore the insured to the same financial position they were in before the loss occurred. Now, in the case of life insurance, the principle of indemnity does not apply because life insurance involves the loss of human life, which cannot be quantified purely in financial terms. Instead, it provides a determined benefit amount or the death benefit to the beneficiaries upon the insured person's death. The focus is on providing financial security and support to the beneficiaries rather than indemnifying a specific financial loss. So the correct answer is option A, life insurance. Now next question, surrender value is related to. Your options are marine insurance, general insurance, life insurance and fire insurance. Now the surrender value is related to option C, that is life insurance. Now what is surrender value? Surrender value is a term used in life insurance policies. It refers to the amount of money that an insurance company will pay to the policyholder if they choose to terminate the policy before its maturity or surrender the policy back to the insurance company. The surrender value is typically a portion of the total premiums paid, adjusted for any applicable charges or deduction. In life insurance, the surrender value serves as a means for policyholders to terminate the policy and receive some financial value in return. It allows them to access the accumulated cash value within the policy, which may have grown over time through premium payments and investment returns. Hence, the correct answer is option C, that is life insurance. Next question, life insurance is taken for. Your options are only risk, neither risk or investment, and both risk and investment. So the correct answer is option D. Both risk and investment. Now life insurance serves two main purposes: managing financial risk and providing investment opportunities. On the risk management side, life insurance provides a death benefit to the beneficiaries upon the insured person's death. Additionally, there is an investment component as well. Certain types of life insurance policies, such as whole life insurance policy or universal life insurance, include a cash value component. The policyholder pays a premium and a portion of those premium goes towards building cash value over time. The cash value can be accessed or used for various purposes such as loans, withdrawals, or as such sources of retirement income. Therefore, life insurance combines elements of risk protection and investment, making it a valuable financial tool for individuals and families. So the correct answer is option D. Life insurance is taken for both risk and investment. Now, when was the general insurance business nationalized? Your options are 1970, 1972, 1973 and 1975. So the correct answer is option B, that is 1972. Your general insurance business was nationalized in 1972. Now next question. Fire insurance covers. Now what does fire insurance covers? Element of risk only, element of investment, both A and B and neither A and B. So a fire insurance covers, that is option A, an element of risk only. Now fire insurance is a type of insurance that provides coverage for damage or loss caused by fire. It is primarily designed to protect against the financial consequences of fire-related risks such as damage to property, loss of assets, or the cost of rebuilding or repairing the structure. Now, the fire insurance policies typically do not have an investment component or provide any return on investment. They focus on mitigating the risk associated with fire and providing compensation for the insured financial losses in case of fire-related accidents. Therefore, fire insurance covers the element of risk only and not the investment element. Next question. Insurable interest is present at the time of contract and payment of claim in. Your options are motor insurance, marine insurance and fire insurance. Now, the insurable interest refers to legal or financial interest that a person possesses in the property or subject matter of an insurance policy. It is a fundamental principle in insurance requiring the policyholder to have a valid interest in the insured property or person at the time of entering into the insurance contract and when filing a claim or compensation. So the correct answer is option D, that is fire insurance. Now in fire insurance, the policyholder must have an insurable interest in the property being insured, such as ownership or legal interest, at the time of insurance policy is purchased. Now this means that the policyholder should have a financial stake in the property, such as owning or having a legal interest in it. Insurable interest is necessary to prevent moral hazards and ensure that the policyholder has a genuine interest in protecting the insured property. So the correct answer is option D, that is fire insurance. Now moving on to next question. The principle of subrogation applies to. Your options are marine insurance, fire insurance, marine and fire insurance and life insurance. So the principle of subrogation allows the company, after setting a claim, to step into the shoes of the insured and pursue the rights and remedies the insured may have against third parties. Now this principle applies to various types of insurance policies including marine and fire insurance policies. Now in marine insurance policy, if the insurance company pays a claim for loss or damage to a ship or cargo, it can seek recovery from responsible parties such as the ship owners, carriers or other third parties whose action or negligence contributed to the loss. Similarly, in fire insurance, if the insurance company compensates the insured for property damage or loss caused by fire, it can pursue subrogation rights against any responsible parties, such as those who caused the fire or who may be liable for the damages. So the principle of subrogation applies to both, that is marine and fire insurance. So the correct answer is option C, that is marine and fire insurance. Now the average clause in marine loss relates to, your options are loss, rebruisement, payment of claims and compensation. Now the average clause is a provision in marine insurance that deals with the distribution of loss or damage in case where the insured value of the cargo or vessel is less than the actual value of the vessel at the time of the loss. It is designed to ensure that each party bears a proportionate share of the loss based on their respective interest. And when the loss occurs in marine insurance, if the value of the insured property exceeds the insured value declared in the policy, the average clause comes into effect. It is applied to determine the proportion of the loss that the insurer will cover. The insured is responsible for bearing a proportionate share of the loss that corresponds to the underinsured value of the property. Hence, the correct answer is option A, that is loss. Now moving on to next question. Which of the following is the predecessor of IRDA Act 1991? So the predecessor of IRDA Act 1991, the options are Insurance Act 1938, the Life Insurance Corporation Act 1956, the Marine Insurance Act 1963, and the Public Liability Insurance Act 1999. So the Insurance Act, which was a predecessor to the IRDA Act 1999, is the Insurance Act of 1938, that is option A. Now it was a primary legislation governing the insurance sector in India before the establishment of IRDA, that is the Insurance Regulatory and Development Authority. The Insurance Act 1938 provided the legal framework for the regulation and supervision of insurance companies, their operations, and the protection of policyholders' interest. Now moving on to next question. The policy with no maturity period, which is payable only after the death of the insured and which has a lower premium rate. Your options are adjustment life policy, joint life policy, annual policy, and whole life policy. So the policy described with no maturity period and payable only after the death of the insured is option D, that is whole life policy. Now whole life policy is a type of life insurance policy that provides coverage for the entire lifetime of the insured individual. It does not have a specific maturity period and remains in force as long as the premiums are paid. The death benefit of a whole life policy is payable to the beneficiaries upon the death of the insured. So the correct answer is option D, that is whole life policy. Now next question, that is question number 17. Insurance interest should be present in. Your options are life insurance policy, marine insurance policy, fire insurance policy, and option D, all of the above. So the correct answer is option D, that is all of the above. Now insurance interest should be present there in any kind of insurance policy taken. It is a fundamental principle in insurance that requires the policy holder to have a valid interest in the subject matter of the insurance policy, And this applies to all kinds of insurance, including life insurance, marine insurance, and fire insurance. So the correct answer is option D, that is all of the above. Now, principles of insurance are inclusive of insurable interest, utmost good faith, indemnity, and option D, all of the above. So the correct answer is option D, all of the above. All these principles, that is insurable interest, that is the person who is getting an insurance policy should have an insurable interest in the subject matter of insurance, utmost good faith, that there should be no hiding of any material facts between the insured and the insurance company, and that of indemnity. All these are the main principles of insurance. Hence, principles of insurance are inclusive of all of them. Therefore, the correct answer is option D, all of the above. Now, moving on to next question. Bill of lading is issued by. Your options are shipping company, exporter, and importer. So the correct answer is option A, that is shipping company. A bill of lading is a legal document issued by the shipping company or carrier to acknowledge the receipt of goods for shipment. It serves as evidence of the contract of carriage between the shipper and the carrier, that is the shipping company. So the shipping company is responsible for issuing the bill of lading, as it acts as a receipt of the goods and provides a title to the goods during the transit. Therefore, the correct answer is option A, that is shipping company. Now, the term causa proxima implies that the loss must arise from. Your options are the nearest place, ascertainable source, cost insured against, and option D, unforeseen sources. So causa proxima means the proximate cause of loss that has been insured against in the insurance policy. So the correct answer is option C, the cause insured against in the insurance policy. So the correct answer is option C, for the term causa proxima implies the loss must arise from the cause insured against. Now moving on to next question. Where was the fire insurance originated? Your options are United States, Germany, France, and England. So the fire insurance originated in option B, that is Germany. Germany was the first place where fire insurance was originated. Now moving on to next question, question number 22. In which year was the life insurance business nationalized in India? Your options are 1854, 1954, and 1956. So in India, the life insurance industry was nationalized during 1956. It was done through the Life Insurance Corporation Act 1956, and this act established the Life Insurance Corporation of India, that is LIC, as a statutory body and brought all existing life insurance companies under its control. So the correct answer is option D, that is 1956. Life insurance business was nationalized in India in 1956. Now the next question. Which of the following may be described as a social device to reduce the risk of loss of life and property? Your options are savings, investment, loan, and option D, insurance. So the correct answer is option D, that is insurance. Insurance is a social device designed to reduce the financial impact of potential losses or risk to life and property. It provides individuals and businesses with a means of transferring the risk of potential losses to an insurance company in exchange for the payment of premiums. So the correct answer is insurance, that is option D. Now the next question, which one is not a principle of insurance? Now your options are causa proxima, subrogation, profit maximization and utmost good faith. Now the option that is not a principle of insurance is option C, that is profit maximization. Because the principles of insurance are fundamental concepts that guide the insurance industry and the relationship between insurer and policyholders. They establish the framework for how insurance contracts are formed, interpreted and enforced, and are commonly recognized principles include causa proxima, subrogation, utmost good faith, indemnity, etc. But profit maximization is not considered a principle of insurance because while insurance companies aim to operate profitability, it is not a guiding principle that directly pertains to the nature of insurance contract or the relationship between insurers and the policyholders. Therefore, the correct answer is option C, that is profit maximization. Now moving on to next question. The General Insurance Corporation was established during which year? Your options are 1972, 1978 and 1980. So the General Insurance Corporation or GIC of India was established in the year 1972. That is your option B. It was formed in pursuance of the General Insurance Business Nationalization Act 1972, which aimed to nationalize the general insurance industry in India and bring it under the control of the government. So the correct answer is option B, that is 1972. Now the next question, question number 26. What is the maximum period of fire insurance that can be done? So your options are 2 months, 3 months, 6 months and 12 months. So the maximum period of fire insurance that can be done is option D, that is 12 months. Fire insurance policies typically have a maximum policy period of 12 months. This means that the policy coverage is in effect for a period of 1 year from the policy inception or renewal date. Now, during this 12-month period, the insured property is protected against the risk of fire damage or loss. The insurance policy will specify the coverage details, exclusions, terms, and conditions, including the premium payment schedule. Therefore, the correct answer is option D, that is 12 months. Now, moving on to next question. An insurance company agrees to compensate the insured person in consideration of a sum of money. This is known as, your options are subject matter, premium, policy and none of these. So an insurance company agrees to compensate the insured person in consideration of a sum of money. This is known as option B, that is premium. Now in insurance, the premium is the amount of money paid by the insured person or policyholder to the insurance company in exchange for the coverage provided by the insurance policy. It is a consideration or payment made by the insured to the insurer to obtain the insurance protection against specified risk. Therefore, the correct answer is option B, that is premium. Now, next question, a representative of an insurance company shall sell policies on behalf of an insurance company is called. Your answers are broker, agent, insurer and insured. So the correct answer is option B, that is an agent. Now an insurance agent is an individual or entity authorized by an insurance company to sell insurance policies and provide Services on behalf of the insurer. Agents act as intermediaries between the insurance company and the policyholders or potential insured individual or businesses. Therefore, the correct answer is option B, that is an agent. Now moving on to next question. If the amount for which an object of insurance is insured at more than its actual value, it is called. Your options are reinsurance, overinsurance, co-insurance and double insurance. So if the amount for which an object of insurance is insured is more than its actual value, it is known as overinsurance. That is option B. Now overinsurance occurs when the insured value of an object or a property exceeds its actual value or replacement cost. In other words, it means that the insurance coverage is higher than the value of the insured property or the potential loss that it can incur. Therefore, the correct answer is option B, that is overinsurance. Now moving on to next question. Under which type of policy does the premium remains at the lowest? Your options are endowment policy, money back policy, term policy. So, under the term policy or term insurance policy, the premium typically remains the lowest. Therefore, your correct answer is option C, that is term insurance policy. Now, term insurance policies are designed to provide coverage for a specific term or duration, such as 10 years, 20 years, or 30 years. Alright, so these policies focus solely on providing a death benefit to the beneficiary in the event of insured's death during the policy term, for the term for which he or she has been insured. Unlike other types of life insurance policies like endowment policy or money back policy, term insurance policies do not have a savings or investment component. They are purely protection oriented, providing a high amount of coverage for a relatively low premium. Therefore, the correct answer is option C, that is term insurance policy. Now moving on to next question. Which government committee recommended the reopening of insurance sector to the private entrepreneurs? Your options are R.N. Malhotra Committee, Abid Hussain Committee, Bimal Jalan Committee and Rangaranjan Committee. Now, the government committee that recommended the reopening of the insurance sector to the private entrepreneurs is R.N. Malhotra Committee, that is option A. It is officially known as the Committee on Reforms in the Insurance Sector and was established in 1993 by the Government of India. The committee was headed by R.N. Malhotra, a former governor of the RBI. So the correct answer is option A, R.N. Malhotra Committee. Now moving on to next question. Who agrees to compensate the other person against a possible loss? Your options are insurer, insured, annuity holder and the employer. So the correct answer is option A, that is the insurer. The insurer is the party that agrees to compensate the other person, known as the insured, against possible losses. The insured enters into an insurance contract with the insurer, whereby the insured pays a premium in exchange for the insurance or insurer's promise to provide the coverage and financial protection against the specified risk or damage. Therefore, the correct answer is the insurer. Moving on to next question. Which of the following factors exists in life insurance? Your options are investment, security, and none of these. And so the factors that exist in life insurance are both the options, that is investment and security. There should also have been option C, that is both A and B. So in your life insurance policy, the factors of investment and security both are present. So the correct answer is option C, that both A and B are present in life insurance policy. Because the life insurance combines elements of investment and security, life insurance policies have investment components such as the case of cash value policies like whole life insurance or universal life insurance. Whereas talking about the security, it provides financial security to the insured's beneficiaries in the event of the insured's death. It ensures that a sum of money known as the death benefit is paid out to the designated beneficiaries. Therefore, the correct answer is option C. That is investment and security. Both the elements are present in life insurance policy. Now moving on to next question. When was the Insurance Regulatory and Development Authority constituted? Your options are 1980, 1988, 1990 and 1999. So the correct answer is option D, that is 1999. Your Insurance Regulatory and Development Authority, or IRDA, was constituted in the year 1999. Now, what risks are included in marine insurance? So, the risk of hitting the cliffs of the sea, risk of pirates, risk of fire in the sea, and option D, all of these. So, the correct answer is option D, all of these. So, all these risks, that is risk of hitting the cliffs or rocks of underwater of the sea, risk of pirates and risk of fire in the sea, all these risks are included in marine insurance. So the correct answer is option D. Moving on to next question. Insurance is a business based on, your options are health, accident and profit. There has to be another option as well, that is option B, of contract. Now, because your insurance business is based on contract, therefore the correct answer is option B. That is, your insurance business is based on the contract between the insurer and the insured. Now, moving on to next question. Question number 37. At the time of investing funds in life insurance business, what should be kept in mind? Your options are adequacy of the income, principles of safety, option C, both A and B, and option D, none of these. So at the time of investing in the funds in the life insurance business, both the adequacy of the income and the principle of safety should be kept in mind. So the correct answer is option C, that is both A and B. By keeping in mind both the adequacy of the income and principle of safety, life insurance companies strive to ensure the long-term financial stability and security of the company, which ultimately benefits the policy holders. Therefore, the correct answer is option C, both of these. Moving on to next question. A subject matter is insured at more than its actual value. It will be an example of, your options are option A, overinsurance, double insurance, underinsurance and reinsurance. So, when the subject matter is insured at more than its actual value, it is always an example of overinsurance, that is option A. Now, overinsurance means when the actual value of the property or subject matter of insurance is less than the amount for which it is insured in the insurance policy. Therefore, the correct answer is over-insurance. Moving on to next question. That is question number 39. In which type of insurance is insurable interest not required at the time of taking the insurance policy? So your options are accidental insurance, life insurance and marine insurance. So the correct answer to the above question is option D, that is marine insurance. During the time of taking a marine insurance policy, the insurable interest is not required at the time for when the insurance policy is being taken. Therefore, the correct answer is option D, that is marine insurance. Now moving on to next question, question number 40. How is a fire insurance contract? Your options are it is only a personal contract, it is only an indemnity contract, it is both a personal and an indemnity contract, and option D, none of these. So, a fire insurance contract is both a personal and an indemnity contract. Therefore, the correct answer is option C. Now, a fire insurance contract is considered to be a personal contract because it is based on the personal relationship between the insured and the insurer. The contract is entered into based on the specific circumstances and needs of the insured. The term and conditions of the contract are tailored to the insured's property and the risk associated with it. The insured has a direct relationship with the insurer and the contract is binding on both the parties. So that's why a fire insurance is a personal contract. Now talking about the indemnity contract. A fire insurance can also be an indemnity contract, which means it aims to compensate the insured for the actual financial loss suffered due to a fire damage or destruction of the insured property. Now, the purpose of fire insurance is to restore the insured back to the same financial position before the fire occurred, without allowing the insured to earn profits from the loss. Therefore, it is a contract of indemnity, and hence the correct answer is a fire insurance contract is both a personal and indemnity contract. That is option C. Now moving on to next question, question number 41. What does whole life insurance plans in India mean? Now your options are payment will be made on death, payment will be made on retirement, payment will be made when insured attains the age of 70 years, and option D, none of these. So the correct answer is option A, that is payment will be made at the time of death. Now whole life insurance plans typically refer to the life insurance policies where the payments are made on death, regardless of the age at which the insured passes away. Hence the correct answer is option A. Now moving on to next question. Who can sell insurance policies of several life and non-life insurance companies at a time? Your options are surveyors, loss assessors, brokers and insured. So the correct answer is option C, that is brokers. Now brokers are those individuals or entities who are licensed and authorized to sell insurance policies of multiple life and non-life insurance companies. They act as intermediaries between the insurance companies and the insured individuals or businesses. Brokers have in-depth knowledge of various insurance policies offered by different insurers and help their clients in choosing the most suitable policies based on their needs and requirements. They provide unbiased advice and comparison of policies from different insurers, ensuring that the client can make informed decisions. Therefore, the correct answer is option C, that is the brokers. Now moving on to next question. In fire insurance, what can be called moral hazard? Your options are negligence, fraud, setting up fire by the enemy, and option D, all of these. So the correct answer is in this question is option D, that is all of these. Now in fire insurance, moral hazard refers to the presence of factors that increases the likelihood of intentional or negligent action by the insured that may lead to a fire loss. These actions can include negligence, fraud, and setting up fire by the enemy. So the correct answer is all of these, that is option D. Now moving on to next question. The first company in India that transacted insurance business was. Your options are Life Insurance Corporation of India, Oriental Insurance Company, Indian Mercantile Insurance Company, and General Insurance Corporation of India. So the correct answer is option C, Indian Mercantile Insurance Company. It was established in the year 1907 and was the first company in India to transact insurance business, and it operated in both life and non-life insurance sectors. So the correct answer is option C, Indian Mercantile Insurance Company. Moving on to next question. When was the Insurance Act passed? Your options are 1938, 1942, 1945 and 1948. So, the Insurance Act was passed in the year 1938, that is option number A. Now moving on to next question. There are how many types of insurance contracts? Your options are 2, 3, 4 and 5. So the correct answer is there are two types of insurance contracts. Now moving on to next question, question number 48. Which of the following actually works on selling life insurance businesses? Your options are branch manager, development officer, area manager and agent. So the correct answer is option D, that is the agent. Now these are the individuals who work on selling life insurance business on behalf of the insurance company. They are authorized representatives of the insurance company and act as intermediaries between the company and potential policy holders. So the correct answer is option D, that is the agent. Moving on to next question. According to insurance agent regulations, who can be an agent? Your options are a person, a firm, a company, and option D, all of these. So, the correct answer is option D, that is all of these, because according to insurance agent regulations, all of these can be an agent. It generally allows individuals or a person to become agents as well as firms and companies. It means that an individual, a firm or a company can obtain the necessary license and authorization to act as an insurance agent representing an insurance company and selling the insurance policies on its behalf. So the correct answer is option D. Now moving on to next question, that is question number 50. When was the IRDA bill passed? Your options are December 1898, December 1989 and December 1999. So the IRDA or the Insurance Regulatory and Development Authority bill was passed in December 19 1999, that is option number D. It was officially known as the Insurance Regulatory and Development Authority Act and was passed by the Parliament of India in December 1999, and it established the IRDA as the regulatory authority for the insurance sector in India. Therefore, the correct answer is option D, that is December 1999 was when the IRDA bill was passed by the Indian government. Now moving on to next question. Agent, surveyors and loss assessors are considered as what in the field of insurance? Your options are option A, intermediaries, employers, regulators and managers. So the agents, surveyors and the loss assessors, all three of them are considered as intermediaries in the field of insurance. Therefore, the correct answer is option A. Now, intermediaries play a crucial role in facilitating the insurance process and act as the link between the insurance company and the insured. The agents, surveyors and the loss assessors are all examples of the intermediaries. Therefore, the correct answer is option A, that is intermediaries. Now, moving on to next question. Insurance is. Your options are gambling, donation, method of risk transfer, and option D, none of these. Now, what is insurance? So the correct answer is it is a method of risk transfer, that is option C. So insurance is a method of transferring risk because it is a financial mechanism that allows individuals or organizations to transfer the risk of potential losses to an insurance company. In exchange for paying a premium, the insurance company agrees to provide financial compensation or coverage in the event of specified losses or events such as accidents, illness, property damage or liabilities. Therefore, through insurance, the insured usually transfers his or her risk to the insurer, that is the insurance company. So the correct answer is option C. That is, insurance is a method of risk transfer. Now moving on to next question. Where is the head of National Insurance Company Limited is situated? So your options are Kanpur, New Delhi, Chennai. And there has to be one more option, that is option A, that is Kolkata. So the head office of National Insurance Company Limited is situated at option A, that is Kolkata. Kolkata is the place where the head office of National Insurance Company Limited is established. Moving on to next question, question number 54. What is the full form of GA in insurance? Your options are guaranteed average, guaranteed assurance, general average and general assurance. So the full form of GA in insurance is option C, that is general average. Now what is general average? It is a principle in marine insurance where all parties involved in a maritime adventure contribute proportionately to cover the losses incurred for the common good. It refers to the intentional sacrifice or expenditure made to safeguard the entire voyage and is based on the understanding that the losses should be shared by all parties involved. General average situations can arise when certain goods or parts of ships are jettisoned or expenses are incurred to prevent or minimize further losses. Therefore, the correct answer is option C, that is general average. Now moving on to next question. The doctrine of caveat emptor is related to which type of contract? Your options are option A, life insurance contract, commercial contract, marine insurance contract, and fire insurance contracts. So the doctrine of caveat emptor is related to commercial contracts, that is option B. Now caveat emptor is a Latin term that translates let the buyer be aware. It is a principle that places the responsibility on the buyer to conduct the due diligence and be aware of the conditions, qualities, and suitability of the goods or services they are purchasing in a commercial transaction. Under this doctrine, the seller is not obligated to disclose any defects or issues with the product unless there is an express warranty or misrepresentation. Therefore, the correct answer is option B, that is commercial contracts. Now moving on to next question. An insurer who takes a guarantee from direct insurer is known as. Your options are double insurer, reinsurer, indirect insurer, and direct insurer. So the correct answer is option B, that is reinsurer. Now reinsurance is a process in which an insurance company, let's suppose A, transfers a portion of its risk to another insurance company, that is B. The reinsurer. Now B is the reinsurer. Reinsurer provides financial protection to the direct insurer, that is the company A, by accepting some of the risk and liabilities associated with the insurance policies issued by the direct insurer. The reinsurer acts as an additional layer of coverage for the direct insurer, helping them to manage the risk exposure. Therefore, the correct answer is option B, that is reinsurer. Now moving on to next question. Which principle applies in fire insurance contract? Your options are option A, principle of utmost good faith, principle of indemnity, principle of insurable interest, and last option is option D, that is all of these. So the principle of utmost good faith, indemnity, and insurable interest, all of these are present in a fire insurance contract. Therefore, the correct answer is option D, that is all of these. Now moving on to next question. Insurance companies collect a fixed amount from its customers at a fixed interval of time. It is called. Your options are EMI, premium, installments, and contributions. So the correct answer is option B, that is premium. Now the insurance companies collect a fixed amount from their customers at a fixed interval of time, which is known as the premium. The premium is the payment made by the insured to the insurer in exchange for the insurance coverage provided by the policy. It can be paid monthly, quarterly, annually, or according to the agreed upon terms of the insurance contract. Now the premium amount is determined based on various factors such as the type of insurance, coverage amount, risk profile, and the insured and other relevant considerations. Therefore, the correct answer is option B, that is premium. Now moving on to next question. Who gets his life or property safe against risk? Your options are insurer, insured, assurer, and none of these. So the correct answer is option B, that is insured. Now the insured is a person or entity who obtains the insurance coverage to protect their life, health, or property against various risks. The insured pays the premium to the insurer, that is the insurance company, in exchange for the promise of the financial compensation or coverage in the event of a covered loss or accident. The insurance policy outlines the terms and conditions of the coverage provided by the insurer to the insured. Therefore, the correct answer is option B, that is insured. Now the remaining questions shall be covered in the part B of the same video. So please go through these questions thoroughly because these are quite important keeping in view your semester exams. And do not forget to download our mobile app from Google Play Store because next videos or discussion videos regarding these MCQs or any other such important topics shall be provided on our app only. There will be no more YouTube videos for the same. And for students of Hindi medium, you will also get the access to your classes or discussion videos regarding these MCQs in Hindi on a mobile app. So do not forget to download our mobile app of LU Update from Google Play Store. Thank you.